Greetings class, Dr. Royer here, and this is the video for session 7. It doesn't seem possible, but we're already here. And in this session, we're looking at the discussion, some of the assignments, and the content in the book that we're going to look at for this week. So to begin with, the discussion that's due this week, and this is Wednesday, so this is just a gentle reminder that we have a discussion due tonight. And this discussion is going to relate to tax equity, and we're going to look at how tax equity is defined. We're going to look at Adam Smith's definition that was introduced in the beginning of the book, and how good taxes are fair and equitable. And then we're going to get a situation here, and we're going to reflect on that and respond to these prompts. What is equity, and how do we determine that, and how does our Christian worldview influence our identification of what is equitable and not. Then we're going to look at the textbook problems, but in chapter 6, I'd like to kind of go through the material with you here. Beginning in chapter 6, we talk about the deductibility of expenses. And when we talk about these, we're basically looking at what is income. Well, when they define income, they define it very broadly. And basically, with that, they're talking about any income that you make is taxable unless it's specifically excluded. However, when you're talking about the deductibility of expenses, only specifically identified expenses can be deducted. It doesn't seem totally fair, but it is there, and that's the way that it is. But essentially what it means is that Congress can decide from year to year which expenses are deductible and which are not. And generally, deductibility for is related to business or trade expenses. And with this, what they're talking about in the term trade or business, they're talking about something where you're actually in business to earn income and to make a profit. That's your goal. It's not a hobby. In other words, you're not you care about whether you make a profit or not in the business, and it's your goal to make that income. But a hobby business, or if it was a hobby, you wouldn't necessarily be that concerned about whether you made an income or not. But if it's a business or trade, then you can deduct fully the expenses that you incur related to that within specific guidelines that the IRS has. So we're going to look at those here and talk about what those expenses are. So, for example, what we're talking about expenses, we're going to be talking about what kind of expenses you can deduct. Well, to begin with, expenses have to be ordinary and necessary. That means anybody in the trade or business that you're in would recognize the expenses you're incurring as an ordinary part of doing business, and they would be considered by the profession to be necessary in order to maintain that business. In addition to those two requirements, it also must be reasonable. That is, an expense cannot be unusually high or overstated in the tax deductibility. It needs to be reasonable. That is, what a reasonable, ordinary person in that business would pay for that service. So basically what this is aimed at is somebody who's doing business with a related party, and they may not have a motivation to bargain for that lowest cost, so they may just pay whatever that person decides to charge. And if that's the case, then that's not necessarily reasonable. We have some deductibility limitations here, and they basically are if it's contrary to public policy. And essentially what this means is if you're paying a fine or something of that nature, it's not deductible for tax purposes. Also, if you're paying expenses related to tax-exempt income, you don't get to deduct that because that would be essentially gaming the system to gain a positive cash flow, and you would be actually subsidizing tax-exempt income with taxable income, and they're not going to let you do that. Again, I mentioned the related party, but here anything you're accruing to a related party is not going to be a deductible expense, mainly because the lack of distance or the lack of the arm's length transaction would cause some questionability related to the negotiation that went on for that particular service and whether or not it's actually going to be provided. You can't claim the obligation of another taxpayer either. I mean, typically that's not going to happen. Substantiation. Well, if you're going to claim an expense, you have to be able to substantiate that. That means that you have to provide documentation. Typically, this is related to bills, receipts, any other documentation that you might be able to collect during the year to support the expenses that you're claiming. The timing of the deduction is important as well. We're looking at typically in a business, you're going to be on the accrual method of accounting. And if you use the accrual method of accounting, you have to be able to say that the events have occurred that fix the liability on you. In other words, the services have been delivered and you do owe that liability. There is an economic performance that you are now obligated to pay for. So it can't just be something that's upcoming. It needs to be something that is legitimately owed to another person. With the cash method, you're basically looking at any expenses that you've already paid. Now, this could include you charging something to your credit card, and if you charge something to your credit card, basically it's going to be treated like cash. But if you're on the cash method, you're only going to be able to claim things when they are paid, not when they're due. And so simply promising to pay something does not really constitute a payment. There are restrictions on prepaid expenses as well, and that means basically if you prepay expenses, you may be able to claim expenses related to assets that are going to be used by the close of the following business year. Those can be deductible, and prepaid rent is deductible in the period you're paying it only to if the prepaid period does not exceed 1 year, and you have a contractual obligation to prepay rent beyond the current tax year. So in other words, it's not just prepaying it this year, it's that you will have to prepay it in future years. Okay, then we want to talk about starting a business and costs of startup and that sort of thing. Well, with startup costs and organizational costs, you're going to be limited in deductibility to the first $5,000 in those expenses in the year that they're incurred. However, whatever remains of those can be amortized and deducted in future years over a 15-year period. However, if you exceed $50,000 in startup costs during the startup of the business, the deductibility of your expenses in the current year are reduced dollar for dollar. So, for example, if you have more than $55,000 in startup costs, you will have to amortize all of the costs over 15 years. So if you have $50,000, you can deduct $5,000 in the current year and amortize the rest. But if you have $55,000, you cannot deduct any of it. Anywhere in between 50 and 55, you have a rateable reduction of whatever you can claim in the current year. Now, organization costs are the same as startup expenses, and typically organizational costs relate to preparing articles of incorporation or something of that nature, going to an attorney, basically forming a corporate charter, organizational meetings, and so on. Those are under the same criteria as startup costs. So again, if you have $50,000 in startup costs, you can deduct up to $5,000 in the current year for those costs and amortize the rest over 15. But if you reach $55,000, again, you'll have to completely amortize that over the 15-year period. Operating expenses. Typically, operating expenses are going to be fully deductible in a business. Most of them are typical operating expenses are going to be things like rent, insurance, interest, legal fees, licenses, and those sort of things. So most of those are going to be fully deductible. There are criteria of expenses, though, that are not. So, for example, business meals and entertainment, those are not fully deductible. They're deductible up to 50% if it's related to business purpose. So you can have a meal and have a discussion related to business at the meal, and that would be deductible up to 50% of that cost. Entertainment activities may also occur during the event, during the meal, or after the meal, or something of that nature. And entertainment costs are like business meal costs, but you have to be able to prove that that meal, or document that meal was related to a business purpose. So, for example, if you're going to look at how you qualify entertainment, meals and entertainment, you may pay for the entertainment of a client. You may take them out for a meal and then have some form of entertainment along with that or after that. But you need to have either a directly related purpose for business. In other words, during that entertainment, you have a conversation related to business, or if the event is a loud event, there's a high enough noise level, you're not going to be able to have a conversation. You may have you may qualify to be considered for that event to be considered associated with the business if you had a business meeting prior to the entertainment or after the entertainment event that you're talking about. And again, if you're paying for entertainment, the limit is 50%, and it applies to the face value of the tickets. So if you pay for scalped tickets and you pay a premium, your deduction is limited to 50% of the face value of those tickets. So when we're talking about how we consider those deductions, we want to think about also businesses who may purchase or own a facility related to entertainment. So if you purchase recreational facilities like a hunting lodge or a yacht, or pay membership dues to a country club, those are not deductible for business purposes. That does not apply to professional organizations, though. So if you pay a membership due to the Bar Association or other public organizations like Rotary, Kiwanis, or Lions, or trade organizations, business leagues, chambers of commerce, those are deductible business expenses. However, if you are looking at a country club, that membership fee is not deductible, but the meals that you provide for clients there are deductible up to the 50% limit. So, the other thing we need to consider is travel away from home. Travel expenses include those amounts that you spend for lodging and meals while you're temporarily away from home on business. And the cost of those that travel and incidental expenses are deductible. They must be reasonable, necessary, and directly relatable to the taxpayer's business in order for you to have them qualify as travel expenses. You must be away from home overnight or away long enough that you require that sleep or rest is required for that evening before you return home. We're talking about lodging exception. Well, there is a local lodging exception. You can deduct lodging expenses, and this is a very limited exception when circumstances show that local lodging are necessary for an employee to perform their job. So if it's needed to participate in a bona fide business meeting or a conference or other business function, even though it's local, it is deductible. Now, they may need to stay at a local hotel. For example, they talk about athletes. Professional athletes have to stay at a local hotel before a game, and that's local lodging. if you have local lodging because you're working overtime, or lodging to avoid a long-distance commute, or temporary housing for a recently relocated employee, those kinds of things, those are not going to qualify. Those are not going to qualify as business-related expenses. If you are on a temporary assignment away from home, those expenses are deductible. However, the length of time is limited to no more than 1 year. It is a temporary assignment. If you go over the 1 year, your tax home automatically shifts to the new location, and you're no longer considered away from home for work purposes. Let's see here. Transportation expenses are the cost of traveling from one place to another when you're not away from home, and include, the automobile expenses, tolls, parking, and so on. Now, when you're using your personal automobile for business, you have to document the actual expenses for the business use portion of the vehicle, or the mileage, and that means that there would be a requirement to keep documentation of some kind, like a mileage log, to demonstrate how many miles you're driving for the purpose of business. If you combine business with pleasure travel, you are going to have some portion of the expense related to business and some that is not. And they appropriate that according to how many business days you're involved in business activities and how many days you're involved in pleasurable activities like sightseeing. So if you take 3 days of a trip and you're conducting business, and you take 1 day of a trip and you go sightseeing, the sightseeing day does not count for business expense, but the 3 days prior to that do. A deduction for travel is not allowable for the spouse or dependent of anybody accompanying the taxpayer, unless that person is also an employee or owner of the business. And the travel must be for bona fide business purposes, and the expenses would otherwise be deductible. So if you're talking about a convention, a seminar, or a meeting, or something of that nature, those are allowable expenses, but that attendance at that meeting must be for the benefit of your business, rather than for social purposes or political purposes or some other unrelated purpose, business that's not related, or purpose that's not related to your business. That's a very important consideration. Insurance premiums for fire, theft, casualty are deductible on business property. If a business self-insures, payments into the self-insurance reserve are not deductible, only the actual losses are. So some businesses do this. They pay into a reserve, and then they compensate themselves if there's a loss. Life insurance premiums paid by a business as employee fringe benefits are deductible, but premiums paid on key person life insurance policies are not, if the business is the beneficiary. Legal expenses are deductible only if you can show that the character of the claim is related to the trade or business, and you're basically defending that trade or business or trying to protect its reputation. Personal legal expenses are not deductible, but legal fees incurred for basically the tax refund or taxable tax. If you're presenting a case in tax court, those legal fees are deductible. Taxes, you can deduct. You cannot deduct federal income tax, but you can deduct other taxes like state, local, and foreign real estate taxes, state and local personal property tax, and those kinds of things. Now you can deduct your portion, the employer's portion of FICA, Social Security, and unemployment taxes. So Social Security and Medicare and unemployment taxes, you can deduct the employer's portion of those, not the employees, but the employers. So you're looking at that, and then any other taxes or foreign taxes that are incurred in doing business. Limited expense deductions. So they talk about here residential real estate, and this is if you have your home and you rent it out for a short period of time. There are basically three scenarios that you can qualify for or be involved with if you're renting out your home for a short period of time. This would be similar to somebody going away and then renting their home out for a 2-week period while they're away or during a particular event in their town. There's a good chart here that discusses how you treat this residential real estate, that you're a residential rental property. And there are 3 criteria here for this. So if you have less than 15 days that somebody is renting this, and you have personal use for the balance of the year, you don't report rental income, but you can't deduct rental expenses. Mortgage, interest, and property taxes are deductible as itemized deductions. Now, if you rent it for more than 14 days, and it does not exceed the greater of 14 days or 10% of rental days, your personal use does not exceed the greater of 14 days or 10% of rental days, then you report rental income and all rental expenses, and property taxes are deducted as itemized. If you're using it for personal use, prorate the property tax for personal use and deduct those as itemized deductions. If you go more than 14 days and your personal use exceeds the greater of 14 days or 10% of rental days, rental income reported and expenses deducted on a rental schedule, but they're limited to rental income, cannot create a loss, and property taxes and so on are deducted as itemized deductions. Now, if you fall in this middle category, there's a formula that you need to use to split out things like property taxes and so on. You calculate the number of rental days to the number of total days used to figure out, okay, what is the rental use expense related to that particular property. So you're going to prorate it based on the days that it was rented. Another limitation on loss is for rental properties, and it's considered a passive activity loss rules. And basically this was enacted because many people were using rental properties as tax shelters. So basically they limited passive activity losses to the amount of passive activity income. So what you have is losses from passive activities can only offset profits from another passive activity, not income from the other 2 categories. And the other 2 categories are going to be active income and portfolio income. So active income will be salaries, wages, and so on. You can't use a passive activity loss to offset salaries, and you cannot use a passive activity loss to offset portfolio income. So these 3 categories are established, and if you have passive activity losses, you can deduct those to the limit of the passive activity gain that you have in that particular year. For home office expenses, you are limited in what you can deduct here. If you are claiming a home office, it has to be an area that's used solely and exclusively for the business, and it has to meet one of these 3 tests. It's the principal place of business for any business of the taxpayer. It's used as a place to meet clients or customers regularly in the normal course of business, and it's located in a structure, or it's located in a structure separate from the home. When they talk about the principal place of business, that means all the administration and management activities, and there's no other fixed location where you can conduct those activities. So if you have a home office, it's a portion of your home. The deductible home office expenses are prorated, typically based on the square footage that's occupied within the home. Now keep in mind, you're going to allocate these costs for these different areas, but the area for the home office has to be solely dedicated to that home office and for business purposes only. So the IRS prefers that you allocate those based on something like square footage. When you're talking about hobby expenses, a hobby is something you're not necessarily motivated to earn a profit. When you're talking about hobby expenses, you cannot create a loss with hobby expenses. So if you have hobby expenses, you can deduct those up to the amount of hobby income you have. But once you hit the hobby income limit, you cannot deduct any more. If you are, and the way they determine whether it's a hobby or a business is whether you have, if you have a gain or income. And I believe in so many years, you can't go indefinitely without a gain or without profit and still be considered a business. You at some point would then become a hobby. Okay, talking about book differences and accounting differences for taxable income. So here's the thing. In accounting, we're talking about the accrual basis of accounting, and we have a specific way of calculating those expenses. And according to the guidance in the Accounting Standards Codification, Section 740, the income tax expense reported on the financial statements must be based on financial statement income rather than taxable income. So that's already going to create a difference because there are differences between financial statement income and taxable income. A permanent difference exists when an expense is never deductible in the tax return. For example, fines and political contributions and expenses with limited deductibility. So if you have meals and entertainment, 50% of that's never going to be deductible. Whereas for financial accounting, it all is deductible. That's a permanent difference. A temporary difference is a timing difference, and basically it's saying, okay, I'm going to deduct these costs now. For example, with startup costs, if you had to amortize those for tax purposes, but you could expense those for accounting purposes, that would be one difference, for example. So a temporary difference would occur when you have a different treatment, but at some point that temporary difference would go away once those expenses are recognized either in tax or in the financial statement. So here are a list of things that you're talking about, temporary differences and permanent differences. And I mentioned one of the temporary differences is organization and startup costs, also bad debts, installment sales, and so on. So you're going to see those differences. One of the things that you have to do with your tax return is for a corporation, you're going to file a Schedule M1 that reconciles the accounting, the book income, with the taxable income reported on the tax return. You're going to account for permanent and temporary differences you've identified in that tax year, and you can find examples of these on the companion website, as I mentioned. If you're a corporation with assets of $10 million or more on the last day of the year, you have to file a Schedule M3 instead of an M1. And basically it's just a different form, and you have to separately disclose each item of income, gain, loss, or deduction or credit for any of the book tax differences greater than $10 million, with temporary differences reported separately from permanent differences on Schedule M3. So you separate those out, essentially. And then basically when you calculate tax expense, if you have this permanent tax differences, you're going to modify the book income by adding back the non-deductible tax expenses and subtracting tax-exempt income. If you only have permanent differences, there are no temporary differences to consider. It determines the book tax expense based on the modified book income at its current tax rate. So that's basically it. Okay, so now I'm on to the textbook problems, and here we have problem 20. We're talking about a taxpayer borrowing a certain amount of money at 10% interest to invest in tax-exempt municipal bonds. What is her interest expense and deduction? And you can basically refer to the content I just covered. Here, there's a lease with office space, and it's a 36-month lease. They have favorable monthly payments by agreeing to prepay the rent for the entire 36-month period. If they pay that entire amount on October 1st, how much can they deduct the current year, and so on. Here's one. In January, Marco incurs $2,800 in expenses traveling, this is number 25, to San Diego to investigate the feasibility of acquiring a new business. He acquires the business and forms a new corporation. And then they basically want to know how much is deductible in the first year for those expenses. So we're looking at startup costs there. Here in number 27, Jim is self-employed, takes an important customer to the hockey playoffs. Although the face value of the ticket's only $70, he has to pay a scalper $400 for each ticket. Assuming all other requirements are met, how much can Jim deduct for both tickets? So keep in mind the rules for meals and entertainment there. And in number 30, Tim is on a temporary assignment away from home. He incurs travel expenses during this period of time there, 8 months. So during months 8 through 17, I'm sorry, not 8 months, months 8 through 17. He was there for 7 months, and then there actually turned into 17 months. So what is deductible is tax expenses. And you need to basically keep in mind the rules for temporary work away from home and what constitutes that. 47 is a comprehensive problem for chapters 4 and 6. And basically you have a case here where there's a sole proprietor, and basically they give you all the facts of the case. What is the net income or loss from the business, and how much self-employment tax must Martin pay? So in other words, how will he calculate his self-employment tax? Based on this information, are there any other deductions Martin can claim on his individual tax return other than those on Schedule C? And I believe that's it. Oh, and how would your answers to the above items change if Martin elects to use a simplified method for home office expenses? So again, you go through that problem, respond to those answers and those calculations. And by the way, show your calculation for that one. That's going to be, there's going to be several calculations there. 54 lists 3 types of expenses or allowance that can cause temporary differences between book and taxable income, and explain how the accounting treatment is different from the tax treatment. Why do you think it is different? Then number 60, Ace Builders begins construction on a building. In its contract, it specifies the building must be completed by July 1st, or it must pay a penalty of $100 a day for the delay. They complete the building on July 31st and pay a penalty of $3,000. So you're going to identify the issues. What are the issues, and what are the questions you need to ask as a tax professional when you're looking at a problem like this? Okay, those are all of the textbook problems. Now I want to go back to the final project, because we're going to have a final project in here, and we're going to have 3 comprehensive type problems. The first one is problem number 78 out of chapter 3, and it has you go to the IRS website, use the form 1040, and compute Pierre Lepen's adjusted gross income by entering the following information. And with some of these forms on the website, they're fillable tax forms. You may want to save those and do those as fill-in. You can print it off and fill it in if you want and then scan it, but you can also utilize I believe they have PDF formats that you can fill in the blanks and then save it once you're done. If you can't save it, you'll need to print it and complete the tax return. So it's basically a 1040 tax return in Chapter 3, Problem 78. Okay, then we're going to go down to Chapter 6, the chapter we were just in, and we're going to look at problem number 75. This is a comprehensive problem for Chapters 4, 5, and 6, and this is going to be Jordan and Diana, basically a tax return. You're going to figure out, okay, here Jordan is a manager, Diane worked at a local department store, they paid interest on their home, real estate taxes, vacation home, so on. So, and they're going to give you different situations. They're going to identify these items here. They're going to have these expenses not reimbursed by employer, or will Jordan be able to, or will he be able to deduct these expenses? So, for example, with the travel expense, Jordan traveled in his BMW, a total of 12,000 miles during the year, while conducting business for the first half of the year. And then they go through the situation, determine what can be deductible, if anything. Jordan attended work-related conference, paid a fee, incurred costs, and so on. He was not reimbursed for these expenses. And then in August, Diane quit her job, began a consulting business. The business code is, and she operated the business on her own name and rented a small office. Since she began her business so late in the year, her consulting income was only $8,000, and she incurred the following expenses. So, what are those items that need to be considered there? Based on this information, prepare a 1040 form, Schedule A and Schedule C, or CEZ if appropriate, Schedule E and Schedule SE using the forms available on the IRS website. Now, again, these may be fillable. In the past they have been, but I'm not certain whether you can save them as you fill them in. If they are not savable, if you can't save them as a new document, then you'll want to print those off and fill them in. So complete those forms. And then the last problem in this chapter for the final project, these 3 tax returns are going to make up your final project in the course. And the last one is going to come from Chapter 10. I need to find it here for you. But Chapter 10, here it is. We're going to have a business tax return. And again, this is the Snap-it Corporation, and began operations January 15th of the current year. They give all the details for that. They talk about income. They talk about the formation of the corporation. They talk about their products, their income, their expenses, and so on. So, your job here is, again, to download the appropriate forms. Again, download the appropriate forms and complete the tax return. Now, again, it's a corporation, so you're going to use Form 1120 for the corporation and Form 4562 to complete all the information that you need to. So, you want to complete these problems as a part of your final project. Now remember, the problems and the project are due Sunday night at midnight. If you have any questions, feel free to ask, and I will respond to your questions as soon as I get them. But again, it's been a pleasure being in this class with you, and again, good luck on this final project and on all the problems. And if you have any questions, feel free to contact me. I'll be glad to help in any way that I can. Have a blessed week and a wonderful weekend.